All right, welcome everybody. I know we have folks in the Zoom room. They're like, well, we've been here for a little bit. We've already talked for about an hour with the Growth Collective, but everybody else, welcome. It's our 1 p.m. on Thursday, 1 p.m. Eastern time, that is. And I'm here, Douglas J. Beck, as your host, and hoping that we're going to have another person joining us shortly here. I think you might be able to for at least 15 minutes or so. A buddy of mine, a friend, an experienced investor, someone that's been through multiple market cycles. I just invited him to join us today. So hopefully he's able to pop in. But in the meantime, I want to welcome you all. I want to ask that if you haven't been here before, do us the favor and inside the actual commenting feature on Facebook, go ahead and put your contact or how, what you do, where you're located, however you want to be contacted, send me a DM, here's my phone, whatever you want to do. Totally fine. We allow networking in this group. It's just got to be deliberate and kind of one-to-one. Ideally, we're not looking for people to post stuff. That's a different story. If you have a question about if I could post something, how would that work? Just hit me up on a DM. There's a process involved. We can talk to you more about that. But generally speaking, just so you guys know, this is a group for folks to learn and grow and also get connected intentionally. So we just talked about this inside of our Growth Collective conversation. We do a weekly, basically a group session here inside the Growth Collective, which is a combination of question and answers, but it's also what we call our hot seat, which basically means you can come in and actually have a deal, a presentation, a situation, a challenge, an opportunity, whatever you want to call it. And we'll go into deeper dive on that. So just today, actually, we had one of our newer members of the Growth Collective community, as well as one of our other members in the Growth Collective in the private coaching group, basically talking about, one individual wants to wholesale, the other person wants to potentially buy, connecting folks and making connections happen deliberately inside the group. Again, you guys could do that as well in this group, in the real estate investing mastermind, but we do that intentionally in our Zoom room and outside of that in our Growth Collective community. So again, join the growthcollective.com. If you don't know anything about it, if you're not sure if it's a good fit, there's a short little video there that kind of explains on the website. I got some noise in the background here. It must be my landscaper or something because I had some issues before. Give me 1 second. I got a good guard dog. Someone told me that the other day. I forget who it was. I was on the phone. They're like, "Hey, your dog's bark." I'm like, "My dog's barking." He's like, "Well, that's what you want them to do. That's why you have a dog, right?" Yeah, except when you're doing a presentation to a few people in a room. So at the end of the day, like I said, this is real life. Okay. So let me do this. I want to definitely dive into the stuff for today, but I want to remind you all that this is interactive. Okay. So this is interactive in the sense that we want to use the comment feature on Facebook. We want to use the Zoom, if you're inside of Zoom, the chat feature to stay interactive. And so, like I said before, the first thing I'd like you all to do is take a second and let us know where you're based out of and what you're focusing on. And if you've been doing this every week, that's also intentional. Think of it as like a virtual kind of networking event, right? An opportunity for people that can see your comment, that can see your post inside the Zoom to understand, okay, Andrea's here today, Janet's here today, Sherry's here, Gabriel, we got Ron, we got also Esther and Joe Tutos today. We got Jasmine and Wendy and Rich. So like folks in the room, what's up, everybody? I just want to do a quick showcase. We'll kind of put on the gallery so you guys can see we're in a Zoom room. It's real life, just in case the Facebook folks don't know what's going on or they're like, hey, is this guy really talking to people in a room or is he just like saying that? All right. So there we go. You guys can see some folks popping in. Not everybody has their cameras on. We got about 15 people in the room. So a little bit about my background, just briefly, because I want to be putting some disclaimers out there about my perspective. Okay. My perspective in the sense of cycles. We're going to be talking about timing and real estate cycles today to some extent. I started my real estate investing business officially in 2014, right? I haven't been in this business very long relative to many other folks that are maybe in your sphere or people that we know are out there that can talk about this topic. So I want to tell you that today is just my opinion, my perspective, my thoughts. I'm going to give you some specific steps to use and specific observations and stats and things to consider when you're looking at timing of a real estate scenario, whether it's a purchase or a sale or an opportunity to fix and flip or keep a property, all those different things. We're going to talk about the macroeconomics effectively in some extent of what's happening in real estate, what's happening with capital, what's happening with inflation, all these different things, how it relates to what we need to think about when we're purchasing properties and selling properties. And then we're going to hopefully have some conversation with the friend, like I said, if he's able to join us. Something might have come up. I know it was kind of spurred a moment there, but basically looking to have him come in to talk with us today about, how he has seen over the course of a couple real estate cycles, because he's actually lived through as a real estate agent and investor across two or so real estate cycles. Most would argue that, we're in the same cycle that we had starting in 2008, 2009, kind of on the up on after a recession, right? Going into now a rise, if you would, over the course of the past, 15 years almost, and almost 15 years. It's a long time. A lot of people, were expecting before COVID for the real estate market to start slowing down and take a hit and kind of correct itself. And then it kind of COVID stepped in, and maybe that's part of it. Who knows? You know, we're not here to talk about conspiracy theories, but there's all different kinds of things out there about this. But the fact is, COVID coincidentally put a wrinkle in the market in the sense of what people expected, at least, because of the timing. So if you guys don't know, like generally speaking, and then you guys can tell me if you have difference of opinion, by all means. This isn't just like a Doug show. This is for everybody to understand different angles, different perspectives, different opinions. But generally speaking, real estate cycles are between 10 to 12 years, maybe 14 years. You know, that's historically. But what is a cycle? A cycle means like, you know, the property values rise and then the property values go down. And the cycle is pretty much from that middle part where it goes from, you know, where it was down and back up again. And so essentially we were at what a lot of people felt like was the top. In fact, I had a rental property in New Jersey that I was planning on keeping for a lot longer. This is back in 2018, 2019. And we decided, because the market was so good, that it was good to exit that rental property and actually sell it. And so we did that. But what did I know? Now it's like another 50% more valuable than it was when we sold it. So it's just tough, right? We can't time things perfectly. That's also a very, very important takeaway. So if you're listening to me, and I hope you are, and you're taking notes, right? Take some notes today. It's not about timing things perfectly, because that's not possible, really. I mean, it's just not. The only thing that's in control, in my opinion, the only thing that's in control of timing is really not us as humans. It's actually God above, right? God is a spiritual being. He only knows the time and the place that things are going to happen, not me. I can't foresee the future. I don't have a crystal ball. I don't have any of that stuff. In fact, I was talking to the group I have here, though, my Bible, right? And this Bible is a little bit different. It's the John C. Maxwell Bible. So I'm not afraid to tell you guys about my faith. Like, this is actually real life. I opened my Bible. This is not planned. This was yesterday. I put up a picture on my Facebook. If you didn't see my Facebook post, I think it was yesterday, the day before. It was literally like this. My Bible was closed and I opened it, and I opened it right to the 21 laws, Esther and the law of timing. Right. And I'm not going to like read to you like we're going to sleep, you're putting your kids to bed at night or something, but I'm going to tell you, it says when to lead is as important as what to do and where to go. And it says when the right leader and the right moment come together, incredible things happen. Winston Churchill described it like this: there comes a special moment in everyone's life, a moment for which the person was born. That special opportunity, when he seizes it, will fulfill his mission, a mission for what he's uniquely qualified. In that moment, he finds greatness. It is his finest hour. That's Winston Churchill quote. John Maxwell put it there. Reading a situation and knowing what to do are not enough to make you succeed in leadership. Only the right action at the right time will bring success. Anything else exacts a high price. And he goes on to talk about different, scripture references here about how that's connected in the Bible, about the story of Esther and Mordecai and things. I'm not going to read all that to you guys. You guys can read that on your own, but it's Esther 4:6-17, basically. So fact is, though, right, this book here has everything we need. Really, not a lot. It's everything. And it's something that takes a long time to understand, but that's why we go to church, or we go to whatever we believe in. You follow whatever your faith is. But for me, it's church. It's me understanding the word of God, but it's me also then taking that word and the things that are given to me as blessings, as opportunities, and putting it into motion, putting it into action. So what I hear here is that, like, yes, timing's important. Yes. But you know, what's interesting, what I've found is that in real estate investing, it's not about exactly a time to do everything. Like, this is the perfect time for everything to work. It's actually a question of what's the right strategy at the right time. I want you to write that down. What is the right strategy at what time? Okay. So, and perfect. Our guest is coming in the room, so that's excellent. So I'm going to tell you, not every strategy is going to work well at every time. And so I'm going to kind of continue here for another few minutes, and I'm going to bring my buddy Lewis up in a second once he gets settled in. But I'm going to first keep going here for a little bit. I'm going to tell you that, again, before COVID, a lot of people in my network were talking about the market being at the top, at the peak, 2019, end of 2019. It was like, okay, we're pushing the limit here. And then 2020, and then things took a different direction. COVID put a stop on things, but because what happened? I'm going to tell you what happened. What happened when COVID happened was, yes, the world stopped for a little bit. Everything was on pause. Everything completely stopped. But then what happened was money is, in this case, part of the demand equation. So if you guys are tracking notes, I'm talking about economics as well a little bit, because this has to do with how real estate works, is based on supply and demand. When money got super inexpensive, when government was printing out more money than usual, making mortgages super inexpensive for people to lend and borrow money, effectively that created what? That created new demand, okay? And then check it out. The supply, what is that supply? It's real estate. The properties were constricted, withheld, not allowed to be sold, not allowed to be taken, as like what Lewis, for example, has a lot of experiences in auctions and foreclosures and sheriff sales and short sales and all kinds of transactions. Literally, Lewis can come up in a second. He has thousands of transactions and experience. So like, I know, I'm pretty sure he would talk, and I want to hear his perspective today, but when things happen with economics and real estate like that, when outside economic factors affect real estate in this way, as in demand is forced to be increased based on money being less expensive, which means more people can access it. More people could qualify for mortgages than ever before because rates were sub 3% for residential mortgages not that long ago. If you didn't see that, I think everybody here probably knows that. And then we had constricted supply. So question, when demand goes through the roof and supply is going down or just stable, what does that do to prices? Quick Growth Collective, jump in. What does that do to price? When demand goes up and supply stays the same or goes down, what does price typically do?
Go up.
Goes up. All
Goes
right.
up.
Goes
Yeah.
up. So what do you think? Hindsight's 2020. What would have been a great idea? What kind of strategies, and we're going to qualify this in a second. What are some things that we did? I'm going to show you some examples and talk about some examples that would have been great if we had the confidence and we were prepared and we had the certainty to some extent that we had the capacity of courage to go do when COVID happened. What should we have all been doing at that time, you think? Knowing the factors of economics and putting outside the factor of the world was ending, was the apocalypse in most people's minds. Outside of that, what do you think economically would have been a great idea?
Buying.
Buying. Wendy said buying. Somebody else said buying. Right. So you ever had Warren Buffett says, like, kind of go against the grain, like when people are selling, you should be buying kind of thing. And like, it's almost the same in this, in my mind, how I see it, right? It's like, it's really tough to do, right? But we made some decisions and there were a lot of good decisions. There were some challenging decisions as well in that process. We bought a bunch of property, though somebody don't know that probably, but we bought a bunch of fix and flips in the thick of COVID. And that was intentional. And it was also challenging and it was difficult and it was stressful and it was a lot of work because, once you own the property and you have to fix it up. So here's an example of what to consider in timing. Just recently, a few years ago and a couple of years back, that was a thick of the buying process. We bought properties, but then what do we face? We faced the challenge of townships and municipalities closing and not being open. We dealt with obvious things that you would be, of course, people aren't working. Like, what do you expect? Well, yeah, but you also have to consider, we knew that something was going to come because there was things happening in the market. There was less competition. Most people said, I'm not buying. We're out of this for a period. So we want to say, how could we buy? See, like, we want to kind of think the opposite in some cases, because this was the opportunity to step in and say, we're going to buy things at a discount because no one else is there to buy it. There's less demand, but check it out. Within a few months, maybe, I don't know exact time, maybe 6 months in to COVID, there started being relief, maybe even sooner than that, with money was being put into people's hands. This additional monies was being given to people not to work. Like, there was people being put on furlough and getting government money, more discretionary income, more money in their hands. Mortgages got to be less expensive over a period of time for relief, right? So people could still live and buy. But in the process, the supply was constrained. Well, how was the supply constrained? In that moment, and even up until just recently, there was forbearance on, or a moratorium, on foreclosures, right? There was no, in most states, like there was not, I think it was actually a federal thing. Lewis probably knows better than I do, but it was basically not, you couldn't go through a foreclosure process. It was not being allowed. The government wouldn't let it happen. There was also eviction rate moratorium. You couldn't evict a tenant. So you have this property that's becoming challenging. I can't replace my tenant. So what do you think that might do? It's going to cause a landlord to say, maybe I should sell this property. I should think about getting out of this situation that I put myself into, owning this property. Tenant's not paying. I can't evict them. What am I going to do here? And I'm overly simplifying this because a lot of factors that we don't have time to get into today, like there was different relief for different people, and it's not about, any particular side or whatever. The fact is, though, that a lot of weird stuff was happening, right? So this is recent. So then the question becomes, what happens, like fast forward to today, and I want to bring Lewis up after this. What happens fast forward today where money isn't as inexpensive anymore? Money got super expensive relative to only a year ago, right? I was at the front line of a fund. If you guys don't know, I worked for a fund based out of New Jersey for over a year. And I was on the front line, meaning talking to borrowers and trying to help them get their cash out refinances done, their purchases to buy, investment property done. And I'm seeing the cash out refinance volume just drop tremendously. Deals were, quote unquote, dying on the vine, right? They're in the process to close and they would just not close. Why? Well, because the way that rental properties work in commercial lending, the way that this works in the cash out refinances, we have to hit what's called a debt service coverage ratio, otherwise called a DSCR. We talked about this briefly in our Growth Collective meeting. Again, join the growthcollective.com if you want to interact with us in these meetings every week, multiple times a week, and participate, and also look to partner with different people in the group, multiple people making things happen. But again, fact is, money got more expensive. And what happens when the interest rate goes up? Do you think that the payment goes up, stays the same, or goes down? Obviously, it's going to go up. I mean, this is like basic stuff, everybody, right? It's like super simple. If the payment goes up, meaning my monthly mortgage payment's going up to own this rental real estate, we'll say, and if let's say that the qualification process to buy the rental real estate is based upon my payment being a certain number relative to the income. So check it out. You got two numbers, write this down. You got net operating income, otherwise called NOI, and you have DSCR, which is not really a number. It's going to get to that in a second. We're going to talk about the actual payment, the principal and interest payment. So I want you to be very careful. Write this down. It's principal and interest only, not taxes and insurance. And I'll tell you why, because net operating income, otherwise called NOI, takes into account taxes and insurance already. So we're comparing these two numbers. We're saying, okay, borrower A, Bob, wants to go buy or wants to go refinance this property, do a cash out refinance. And at that time, for the program guidelines that we had, it was what's called a 1.25 DSCR minimum. What that basically means in real language is that you have to have at least 25% cash flow available after you pay your debt service, your mortgage payment every month. So the property has to have viability to do the cash out. What is cash out? Well, that means we're getting new money from equity that's been built over time. Now, remember, coming out of COVID, going through COVID, what happened? Property values went through the roof. So don't you think the timing to do a cash out refinance would have been phenomenal, right? And unfortunately, many of those listening to this might have missed that boat, or maybe you didn't. Maybe you took that opportunity. But I say it with an asterisk because unfortunate is relative, okay? There are people that did a cash out refinance on values that were in a inflated real estate situation, which some of it has held support. Other areas and markets will eventually decline faster than others because of different factors, but they're going to have a situation if they wish to sell that they could be facing what's called a short sale because their loan to value, the leverage, the money that they got to get the cash out was beyond the threshold of what the property value actually is after a period of time passes. When the market does what? When the market corrects or adjusts or goes down, as people say. Now, we don't know if it's going to go down. We don't know the economic factors. At least I don't know. I mean, if somebody knows, it'd be amazing to know that, but I'm going to get Lewis up here in a second. Like I said, again, though, DSCR was not being met. So what do you think happened? People said, I can't cash out refinance because the income for the property did not rise fast enough to keep up with the increase in rates. Remember, this is from like March of 2022 over the course of the summertime, basically. Another interesting fact, if you guys don't know about this stuff, look into the yield curve, the inversion of the yield curve between the 2-year treasury bond and the 10-year treasury bond inverted for the first time. I think it was last year in like March, maybe it was April. That was an indicator that's very negative for the economy. And some people talked about it and some people haven't talked about it, but if you're paying attention to any of that stuff, when that happens, like 3/4 at a time or something like that, I don't have the stats in front of me, is an indicator that the recession is happening, that there's things going to face the entire economy is going to be affected by that happening, because basically it's saying that we're betting against today's market. We're saying that's going to go down. That's what basically massive, like institutional level investors are saying. I'd rather have my money, for a shorter period out than a longer period out because I don't trust the market's going to continue to go up, and you get better returns for the one that's shorter versus the one that's longer, essentially. Man, this is timing, right? This is all timing because which side, the question I want you all to think about is which side of that equation are you on, right? Which side am I on? So if the demand is high, I need to be in which position? I want to be either the buyer or the seller. What is better to be, the buyer or the seller when demand is high? Just isolate demand. Demand is high. I want to be fill in the blank. Come on, guys. You got this.
Seller.
Selling. Because there's a lot of people that want to buy my property and they might be willing to pay more because they have cheaper capital. They have less options because I'm one of few available because there's less inventory. Now, check it out. When the equation is the opposite, when demand is lower because of what? Rates are now at 7-8% in commercial lending for DSCR. They were at 3.5%. A friend of mine, and refinanced his entire portfolio. Actually, David, he's in this group, I believe. He's definitely in our Growth Collective group. He refinances almost his entire portfolio at 3.5% locked in 30-year fixed. he says that was $1 million additional that he's going to have over the life of his ownership of those properties. He's going to have in his pocket because of the savings that he got compared to what his rate was, and also the cash out that he was able to get. That's a pretty powerful story, right? But David and I got to know each other from what? A real estate investment group, a RIA. So quick commercial connected to people. So you have these understandings, but this was a scenario right before, literally like it was end of February 2022, we closed. That was the last batch of loans before rates ticked up from 3.5 in commercial DSCR to 4.5, then to 5, 5.5, 6. And then eventually it's like, man, there's not going to be a good scenario here that's going to work for that DSCR because the income is not rising 50% or whatever the percentage was as fast as the rates were going up and the payments were going up. So that's just some ideas. I know it's a lot of information. I know it may not make total sense, but I want to just give some perspective that we have to think about which side of the equation, or which strategy are we going to be buying and holding, or are we going to be fixing and flipping? Well, buy and hold is a longer term strategy. I'm personally less concerned about value today as I am about the stability of the value long term, but I am looking at cash flow today. I'm saying, how much can this property cash flow for me? Is it worth to keep now? And what could it be in the future? Versus fix and flip says, what would happen in the next 6 to 12 months or less if I bought this property, improved the property, and then sold it? Is the market going to hold the same? Is it going to go down, or is it going to go up? And I'll tell you, be very careful with fix and flip as far as the market dynamics. Buy things at a discount. Be conservative with your rehab estimates, right? Be super conservative. Be careful, because if you get into a project and you're at a high leverage point and then you need to sell the property, it may not be possible to sell it at the profit you expected, because these things matter, right? Market factors. And then there's different micro markets, like I call them pricing bands, right? So like under 250 in certain markets is like a certain type of property. 250 to 600 maybe is like another type of property because the type of financing available. And then above 600 to like $1 million, and like $1 million and up is just different things. It's luxury typically in most places, but or like waterfront. We got to say, like, I'm going to ask you guys, what you got to figure out, what are you focusing on? Which pricing bands are you buying and potentially selling in? That matters as to, what are the impacts? Which of those bands will be affected by any sort of correction? Okay. I'm looking at on my screen, BRRRR. This is my final thing here. BRRRR. What is BRRRR? Buy, renovate, rent, refi. I've done multiple trainings about this. Others have come in to talk about it. David's actually an expert at it as well. He's inside the Growth Collective. Again, join the growthcollective.com if you want to learn about the BRRRR process in more detail, work with us on stuff. I'll tell you one thing though, it's becoming more and more difficult to do that BRRRR than it was even a year ago, like I said, for the exact same reason, because of interest rates. Interest rates, my son's here. This is Jude. Hey, Jude, go ahead, buddy. Got back from preschool, I guess, but interest rates, right, are affecting that DSCR, and the BRRRR concept says I'm going to refinance out to pay off either my own money, get my money back, cash out that way, or I'm going to pay off another lender so that I can keep and own this property long-term. But if you can't hit that DSCR, right, debt service coverage ratio, if you can't hit that number because rates are so high, you really can't do a BRRRR and cash flow. So you got to be super careful. So now we're starting to look at, well, what about short-term rental? What about midterm rental? Can those BRRRR? Can I actually make those numbers work because I'm collecting more cash from the tenants or the people reserving my property if they're staying there short term? So anyways, on that note, I want to say thank you to Lewis if he's still here. I hope he is. I know I've been talking a little bit, but he's in the room with us, I believe. Was he still here? There he is. I see him. I'm going to add him up here. What's up, man? How you doing?
Good.
Hopefully I didn't throw you for a loop there with any of my perspectives, man. I want to kind of get some thoughts from you though. I want to first kind of have you maybe talk about your background a little bit, kind of introduce yourself to the group in whatever way you'd like, about your background, your experience and stuff.
Absolutely. I'm a student of real estate. I'm always constantly learning, and I learn from everyone. I learn from new people in the business who are doing things that are outside the box, because maybe the old guys are still doing the same thing over and over again. And I learn from even people outside the industry. You just constantly always have to learn. So I'm a person who just had a passion for real estate early on, while other kids were dreaming about becoming police officers or, doctors. I was always dreaming of being a real estate investor. It was just weird. It was just a fantasy.
Awesome, man.
Yeah, thank you. So fast forward to today, it's been 20 years. This is my 20th year in the business as a licensed agent, but I started investing about a year or two prior to getting into real estate. I got in real estate when I was 22, and a couple years before that, I had convinced my dad to refinance the house and and buy a four family, and we did really well. We made over 100 grand over the course of a year. We caught the market in an upswing, and I said to myself, "This is going to be very easy. You're just going to keep doing this and going to keep making money." And then we smacked right into 2008, and then you actually had to learn how to become an investor, and you actually had to learn how to become a good real estate agent, right? It wasn't just like low hanging fruit anymore. So that's where we're going to right now. We're approaching that time in history that it's really going to shake out the weak hands, and we're going to find out who is really meant for this business, right? There was a time in which you could pick up the phone, make a couple calls, and get a property. Put up bandit signs, get a property. Go to a networking event and meet a wholesaler who's got a slam dunk deal. Even if it wasn't a slam dunk deal, it was a modest deal. By the time you're done renovating it, it's worth more money. So those are easy times, and they don't really build much character, and they're not going to teach you much things. But right now we're getting into that environment, like Doug was saying, that we really have to figure out what's going on in this economy. The interest rates being so high right now at this moment, we've never really seen a time like this where interest rates are very high and inventory is very low. It's usually the opposite. Economics tells us that when interest rates are very high, the demand goes down. Well, our demand is very high because nobody wants to sell their property right now, because then they have to go out and take a new mortgage at a much higher rate. I've seen right now people are doing up to 8%. If you're not paying any points, you're doing 8% on a 30-year fix with good credit. Wow. So they're going from a 3% to an 8%. They're like, yeah, you know what? Maybe I'll just stick around no longer and do some repairs to the house, and keep it just here for a few more years until things level out. Meanwhile, we've got this demand that's being created, because remember, every day new families are formed. Every day new people are born, and there's a whole generation out there that's waiting for home affordability to come down, and it's not happening yet. In some pockets, prices are starting to come down, and others they're not. In other parts of the country, you're still seeing record high prices. You're still seeing demand through the roof. Here in Florida, I see sections that are starting to cool down now, but we have a whole bag of different reasons why real estate might be higher or lower in certain areas of the country for all types of reasons. But in general, what we're waiting on right now is what the Federal Reserve is actually going to deal with. They're going to pivot with their decisions on rate hikes, because even though the Federal Reserve rate hikes really don't have anything to do directly with mortgage rates, they do have a lot to do with the economy. And whatever the economy does also reflects on the 10-year mortgage notes, the 10-year bonds. Those 10-year bonds are like IOUs to the government. And I learned this a long time ago when I had a brief stint in the mortgage business, that mortgage rates are based on the 30-year bond rate. I mean, sorry, the 10-year bond rate.
Yep.
So right now, we are seeing the highest bond rate in over 20 years, about 23 years. So that equates to also having the highest interest rates in over 23 years. So until we can get the economy back on track and get rates down, we're not going to really see a level playing field. We're not going to see a balanced economy. But I will tell you this, it's very likely for rates to actually continue higher before they actually go lower. And the reason I say this is it's not an opinion. I don't give opinions. Last time I tried to predict the real estate market, I was completely wrong. I thought, you can't make any more land. There's always more demand. So prices always have to go up. And then 2008 comes, and then home prices crash. Right? So I don't make predictions anymore. But what I do is I look at the data. So if you look at the historical line chart right now for the 10-year bond note or 30-year mortgage rates, they are at still very low, considering all the history that we've had. Now, what happens with extreme highs and extreme lows is that they end up always finding a medium. There's a center line. There's a high point, and there's a low point, and then there's a center line. For some reason or another, everything in life, everything in business, and everything you could think of always finds its way back up to the midpoint. If we get to that midpoint, I'm not saying we're going to get back to 1985 with interest rates being 18%, but we might get to that midpoint where bond notes, 10-year bond notes are where they were historically at the halfway point, which would put us in double-digit interest rates. So we could see a 9-10% interest rate, and that's not that far away, and it's very possible. If we see that, what we're going to see is a lot of banks defaulting, because there's a lot of banks out there that are holding treasuries at very low interest rates, and they have to service that. They have to service those notes, but they also have to service the new notes, the new customers that come in, because when a new customer
Yep.
comes in, the bank has to give them a return on their money. So if the bank is collecting 1% on the treasury notes that they loaded the boat on a year or two ago, and now if you go into the bank and you open up a high yield account, you're getting 4, 5, 6% maybe in the future, that means that they're literally losing money for every account they open up. And there's a lot of banks right now that are on the brink. And I'm not just talking about regional banks, like local banks. I'm talking
Right.
about like big banks, the ones that we probably all bank with. And if we see one of those events take place where we have a banking crisis on a magnitude of what we saw in 2008 with the subprime housing crisis, we're going to get a flush out. We're going to get a flush out of the economy. People are going to lose their jobs. People are going to start losing their homes. And we can really see a correction of the market that way. Now, that is the catastrophe event that we could see. What we could also see is we can have a soft landing where the Fed ends up lowering rates little by little. The economy gets back on track, and we start getting interest rates for mortgages somewhere in a 5% range, 6% range. We get more sellers off the fence. They start selling their homes, and we start seeing some more inventory hit the market. Then home builders come in and they start building again, and then we start to see more inventory. That would be the other correction. That would be a soft landing. That would be something I'm sure that a lot of people would like to see. But to be honest with you, you got to be prepared for either scenario, because if you're a real estate investor, you can make money on either scenario. So the scenario,
Louis,
the
I'm
first
going to
scenario,
pause
I
you on
think,
that for a second, if you
yeah,
don't
go
mind,
for it.
because that's a really good wavelength. I want you to come back to that. While you were talking, and I want to make it visual for folks too, because I think it's important. Like you said, the data, right?
Mhm.
This is about data and about what's happened and what could happen. I'm going to share my screen because I brought
Yeah,
up
please.
basically Fred, and I brought up the government bond, trading economics site, and I also brought up the FDIC, so you can
Yeah.
see. I'm going to share this on the screen, and we can kind of recap what you just said there. So we'll start off with, this is Fred basically. So Fred is one of the economic research, websites basically. And this is what Lewis was just talking about: 30-year fixed rate mortgage average in the US. This is across, many years here. You can kind of see this is 1980, 1981, I guess, was at the peak, it looks like. And then
Yeah.
relatively speaking, we're down over here, which seems really high. But to Lewis's point, I think I'm hearing you correctly, that we're not really high comparatively speaking to what's been previously in the past few decades.
Correct.
Right. And we're
Absolutely.
kind of getting to that midpoint. If you were to average it out, it's probably somewhere in this range here, is like under 10%, maybe 9% ish.
9 in there. Yeah.
So like, we're not even at the peak of it potentially of what would be the average across this whole year, a number of years it is. That's the 30-year one. And then we look at the bonds, the US government bond 10-year, I think this is the right one.
Yeah.
Across 50 years, we're still, we're down here. This is just the one
Mhm.
bond rate, but I mean, this is way back.
Yeah.
Probably different things going on there, but fact is, like, we're rising, but it's rising rapidly. You see this
Sure.
bump up is within like a few years, so that's
Yeah.
one thing to look at, and you guys could check this out. And then the bank crisis, quote unquote, of what could happen is there, but there's also some banks, in case people don't know, that did already fail not too long ago, actually. So SVB, Signature Bank, First Republic, Heartland, Tri-State, like these are the ones here. And then this is the site that will actually show you banks that have failed and what's going on with those banks and how many millions of monies of deposits and stuff. And so in the non-conventional, like hard money, private money space, in fact, a couple of these banks were what I know to be, and I don't know all the details, I can't disclose everything, what I do know, even because it's, stuff that is private. But the fact is, these banks, in some cases, were backing some of the largest hard money institutions in the country. And those lines of credit essentially that they have are no longer available. And there had to be movement of that capital allocation to another investor, another company, another bank, to be able to continue to do business. Some of these large, national level hard money lending companies basically almost went out of business, but they were able to be acquired by other banks that were international in some cases, and basically recapitalized so they could continue to lend. But it was like substantially lower than, what the bank had as far as their valuation. They bought it at such a discount. So that's not a good sign, right? This is not like, negative news media here. This is just like facts and like saying what to look for in trends. Anything you want to add to that, Lewis, about anything I said so far?
Oh no, absolutely. Well, you're 100% right in everything you're saying here. Do you guys remember? I'm sure most of you are probably in your late 20s, 30s, or even 40s or older. Do you guys remember when our parents and everyone that was older than us used to tell us, save your money, save your money, save your money. And the reason why that was ingrained in us as when we were younger is because you used to actually beat inflation when your money was in the bank. Now, when Doug was showing the 10-year bond notes on the screen before, those are directly tied to what people actually could collect with their money in the bank. But then
Right.
came along, the early 19 over the late 1990s and into the 2000s, where we started seeing that savers were actually losers. Savers
Yeah.
were losing money because inflation was higher than what you were getting in the bank. And then Robert Kiyosaki, I'm sure everybody knows, he's famous for saying that savers are losers and people who take out mortgages are winners. Because if you take out debt and your home appreciates by 5% a year, and that's on the low side, conservative side, then you're beating inflation, right? And then if you've got
Right.
your tenant paying off your home, then you've got an appreciating asset that's being paid off by someone else. Even if the home breaks even every year, you're way ahead. So don't save your money. Savers are losers. Investors
Right.
are winners, So that's kind
Investors
of the
are winners.
mindset
That's
that Doug's
very
trying to
good.
tell you.
That's very smart. And I'm trying to find a good visual, but I can't find one for CPI. I know that when, I was working at Johnson and Johnson in procurement for a while, right before real estate. And this is back
Yeah.
in '07 to 2015, basically. But CPI was the measurement of basically inflation. And we would actually pay vendors, like we would be contractually obligated to increase their pay for the services to cover the inflation. About usually 3% is what was common, right? And then we have that's CPI. And then Lewis, I'm sure you probably know real estate prices and appreciation historically. That's what, 3 to 5% on an average typical year across the past couple of decades, or what would you say that number looks like?
Yeah, I mean, and it depends and it varies widely across different markets, but you can use a 5% average. But the beauty
5%.
of, yeah, but the
Yeah.
beauty of that, guys, is that what a lot of people don't realize is that it's not really 5%. It's 5% compounded. You
Right.
understand? So
That's
first
right.
year, let's say your home is worth 100 grand. Next year, it's worth 105. And next year after that, you have to add 5% to 105.
And 105. Yeah.
Yeah, so it keeps growing and growing exponentially. So that's how the wealthy, really get there, is through means like that, through assets and appreciating and compounding vehicles.
That's right.
I read about compounding when I was young. I read a book. You guys probably are familiar with it. It's called The Richest Man in Babylon, and it talks about being invested into compounding, being able to put money into compounding assets. And I never knew what those things look like until I realized that, wait a minute, real estate can be compounding. If you guys are landlords and you're not raising your rents by 3% every year, or you're not taking advantage of the compounding benefit that you have. If you're not
Right.
investing in real estate, then you're not taking advantage of compounding by the means of appreciation or forced appreciation, if you renovate it.
Right.
So a lot of ways that you can beat the market no matter what happens, guys. Go ahead, Doug.
Even private investment, private lending, those kinds of things, like on our fund, for example, when we have people putting capital into the fund, it's a 506C accredited investor fund.
Yeah.
But the return is not just the 1 year, it's really across, like that principal becomes bigger if they want to invest it again or keep it going, and essentially compounds, like you're saying, Lewis. So 100%. Some folks here probably are thinking, like, is now the right time to buy property? Is now the right time to sell property? Should I invest in property? Like all those things. And you're covering a lot of those concerns.
Yeah.
If you guys in the group inside of Zoom or on Facebook have any specific questions, by all means, put a comment, something in the chat, and then we're going to keep on chatting here ourselves and kind of continue the discussion. But Lewis, take me through like some of the things I think might be on the horizon, but I'm curious what your thoughts are. Is like when the supply opens up a bit, whenever that happens and whenever that happens, when supply starts becoming more available, what do you see, like, based on trends or historical, whatever you want to comment on, like how would that impact the real estate investor side of things or real estate in general? Like when supply goes up and you say like demand's about the same or it's, kind of normalized, is that going to, people are wondering, like, is that going to drop the prices like immediately, or is it going to stabilize things, or is it going to, what's it going to do, you think, to pricing in your mind?
Yeah. So think about this. Envision the real estate market as being a dry sponge, and envision the inventory coming in as water. It's being poured. It's going to soak all of that up initially, but eventually that sponge is not going to be able to hold any more water, and there's going to be an overflow. And once you have that overflow, that's when you start to see the opportunity. When you start seeing real estate not being so popular, when people are like, oh no, investing in real estate is too risky. When you hear that, that's when you know you got to double down. That's when you really go in hard, is when you see things like that. When lending gets difficult, those things really do help you. It's so funny that you're supposed to, literally, like Doug said earlier, you're supposed to go against the grain and contrary to what everyone else is doing. is what you should start preparing for, because things go in cycles. It's not always a great market for investors. It's not always a great market for sellers. It all varies. So if you can find that market where it's difficult for sellers to sell, it becomes a buyer's market. And then one level more after that, it becomes an investor's market when it comes to very unpopular to buy homes. That's when you guys, if it comes, make sure you're ready for it, make sure you're prepared for it. But right now, I'll tell you this much.
Yeah.
I used to believe that with buying properties to flip, you should wait until like the market is favorable. I
Right.
learned the other day recently from somebody who's been doing it even longer than I have, and they've done a lot of real estate investing. They said to me, if you buy a home that you can make a profit on and sell it at the medium home price for that area, if you could, like for instance, let's just say the medium home price for an area is 350, the high end price is 450, the low end price is, I don't know, 275. If you can be all in and renovate it and still make a profit at the median price, which is 350, he said you'll sell homes all day long, even through a recession, even through a crash, because people are still going to need a place to live, no matter
Place
what
to
the
live.
rates
Yeah.
do. Yeah, he said
Totally.
he did this through the 80s. He did this through the 90s. So you'll always be okay. So that's one thing that I want to share with you guys is it doesn't matter what the market does, as long as you play your numbers correctly. It might take you longer, but believe me, you'd be better off waiting for the right property than getting the wrong property and being stuck with it or selling it at a break
Right.
even or loss. Okay, you don't want to do that.
Yeah.
Yeah, the other option
Exactly.
is, the other option is if you want to be really smart and you want to start building long-term wealth, you start looking at investment properties to keep. As long as those properties pay for themselves with a normal tenant, not an Airbnb, because
Right.
what an Airbnb is right now, guys, is equivalent to what I used to see back in 2007 and 8, with people renting their attics and renting their basements to cover these mortgages. That's all that is. And it's a ticking time bomb, because at any point, Airbnb laws could change in your municipality, your city, or your complex, wherever you are, and that option's out the window. Here comes a new property on the market that's being foreclosed because you can't keep up on it anymore. So if you can buy a home for rental purposes, make sure that conservative rent will pay for the rent no matter what happens in the market. Agreed?
Yeah,
That's a
that's
good
really
idea.
good. That's really good. I mean, I'll on the lending side, because that's been what I've been focusing on as well for the past couple of years on, working inside the funds and stuff, is that the guidelines, the underwriting guidelines for a period of time actually excluded, even if it was an Airbnb use that you planned on having this property be an Airbnb, the underwriting for the loan would not be allowed. We wouldn't do an Airbnb underwriting. We'd do a long-term tenancy underwriting because of the exact thing you're saying. Hospitality was one of the industries that took a hit when COVID was really in the thick of it, and
Yeah.
people were not traveling and discretionary income was there, but they just couldn't travel because they were not sure, they were not feeling safe, whatever the case was.
Sure.
And so that was where, impact, like my father actually has a home, he rents out short-term rental in Kissimmee, right? He's had that for almost 20 years and he saw it firsthand. Like I've seen, his occupancy was down to like 40 or 50% for a period of time. Maybe, I think, well, being COVID, it was zero basically, because there was you couldn't legally rent it out. But what I was going to show on my screen was actually, and again, not to be like, we're not trying to be like newsmongers or whatever that saying is. We're just trying to tell you guys facts here, but just, well, yeah, right. Let's just share my screen now, because I want to show you the news about what's happening with Airbnb rules. You have to be careful, right? So New York is about to enforce its Airbnb rules. Hosting guests are scrambling. Richmond proposes new laws. This is just a simple Google search, Airbnb laws. And there's all different things happen. And so you want to stay in touch with what's going on. And you want to understand that also there's people that know more, that are like a lot of times lenders or investors that have been doing this for a long time, that, like Lewis just shared his wisdom, right? He saw that happening in, I think, probably areas like in Essex County and Union County, same places I saw some stuff coming into the real estate business in 2014. They call it like a bonus, right? The bonus apartment or the basement. But then if you're in the basement and there's no egress, you can't legally rent that out anyway. So now people are hacking their properties in ways that are not legal just to make the payment. Like you said, that's not a good business plan. Basically,
Yeah.
it's just not a good idea. So be mindful of that. What I wanted to share also on my screen, I want to see your comments on this, and we'll go into some other stuff as far as kind of closing out the conversation today and kind of talking about next steps for people if they want to plug into more of this kind of stuff. But let's just go and share my screen with a graph that I had here, which, it's not to explain it, but it's just to observe it and see, like, this is effectively a cycle that if you look down here, it's really small. It says Mueller Real Estate Finance 1995. This was kind of established as like the market quadrant cycle, right? So occupancy and time, basically. And so we see, right here it says declining vacancy, expansion, and things like that. Like, people own property, there's low vacancy, people are renting property, buying property, et cetera. demand and supply equilibrium point, new construction. And then what happens is there becomes so much more. Now, the thing is, I don't know exactly where on this we are, but I'm telling you, I don't believe personally, and this is kind of an opinion. So I know, Lewis, you don't have to comment if you don't want about your thoughts on this, but whatever you want to share. Statistically, though, let's go statistics. What is the statistics? What is shortage of new homes in US? The country is short about 3.8 million. I think it's a lot more than that actually, but this says 3.8 million for both rent and for sale. There's a shortage of supply for people. This is from Freddie Mac, right? This is data from a website. It's a .com, but and now here's the 6.5 million. So there's in the millions, right? It's millions of homes. So new construction is happening, which is basically here, but we're not at this tipping point, in my belief. I mean, it could happen, but to Lewis's point, you guys, great analogy. I love that. It makes it super simple. You have a sponge, it's dry, and the properties, the houses, or the water that's going to absorb it. And at some point, it's going to be fully absorbed, and then it's going to obviously not be able to absorb anymore. But we're not necessarily seeing that. There's still a shortage of supply. Yes, money is expensive, but it's requiring, what Lewis said, us to be more mindful of how we buy, what we buy, why we buy it, be intentional and deliberate, right? Not just be like buying anything you find kind of thing. You have to have a due diligence process. And so I know Lewis focuses on this with his company and his staff of agents and also his investment business. And we do as well in ours. And we also have, both of us have different educational and coaching things that we do. So like in the Growth Collective, we focus a lot on analysis and preparation to buy property. We're very diligent. And so, join the growthcollective.com. Lewis has been kind enough to come in and present to our group. He's got some of his own stuff we're going to talk about in a little bit here. If you have anything you want to share on the screen too, man, you're welcome to do that. If you want to share your core stuff that you have, that might be good.
Sure.
But basically, if we have any questions, I'm going to kind of open up for that now, and then we'll kind of close out with anything that Lewis has. I think I saw a hand raised inside the room. Let me see here. Rich, go ahead. You got a question for us, Rich Socon?
Yeah, I wanted to add what you said. I just heard it was 3 or 4 weeks ago. I read it at the National Mortgage Association. They said currently right now for just, people looking to buy, the country is 350,000 houses short, and there is absolutely no new construction making up for that default value right now. They said, so they don't.
Yeah, there's all different
they said,
numbers.
even though the mortgage rates are going up, they said maybe supply, maybe demand is going to slow down a little bit, but there's a 350,000 house shortage. So it is what it is.
Yeah, it's tricky. I mean, I don't have the exact number. I just mentioned there, like it's, one thing says 3.8, the other one says 6.5. I believe it's in the millions total, but maybe the new homes or maybe the homes that owner occupied homes or something, that data is out there, right? So today is not just like, hey, let's show a bunch of data. It's really, but it's a good point though, Rich. You're saying the same thing. It's like supply is still lower than what it needs to be for absorption. Lewis, can you thank you, Rich, for that question.
Yeah, and I think it was really directed at like specifically single family homes.
Excellent.
Not multi-units or anything. I think that was it was very niche, but it was for single family homes. They said approximately 350,000 short, and there's no construction going on anywhere that's going to help make up that difference.
Yeah, exactly. That makes sense. Thank you, man. Appreciate you commenting on that. That's good. Lewis, just before we go to your stuff here, can you comment on absorption rate? Do you feel comfortable sharing kind of with the group here, folks that might not know what that means, or even just the concept of days on market, even indicators, trends, things you're starting to see with the analysis from like the real estate itself, the real estate market itself?
Sure, absolutely. There's two ways you guys can go about this. One way, if you're a licensed real estate agent, you can go on the MLS and you can look at the absorption reports for whatever area, zip code, town that you're in. That's one way to easily do it, or wherever your real estate partner is, have them run these reports for you, because a neutral market is 6 months of inventory. And I believe at the peak when our shortage was really, really bad, I think we had about 2 weeks of inventory in some parts of the country. And our part of the country, we were really down in 2 weeks, which was like ridiculous. There's no inventory. So with that being said, anything over 6 months of inventory, that becomes in a saturated market where it starts to become more of a buyer's market. You have more chance to negotiate. You can take your time to pull the trigger. And right now, in a lot of places, you find a house, and I'm sure another person is right behind you willing to make that offer as well. So still in a very competitive market. So I believe it's still considered to be a seller's market. Now, the other thing you could do, because home builders, they have to think 6 months, a year out, 2 years out, they have to forecast, right? And they have very, very good and high paid analysts that work for them. They have to offer guidance. So there's home builders like Toll Brothers, Lennar, that you can actually go, Horton, DR Horton, you can actually go on their websites and go on their investors relations tab, and you can read their analysis from their from their reports and to see what they're saying about the next 6 months, what they're saying about the next year. Because if you can read that information, you can make an assumption for yourself. Or like, well, I'm going to base my decision whether I start investing now or wait a little bit longer, or are we approaching a tipping point? After you do your own due diligence and you do your research and see what the big
Yeah.
boys are saying and what they're doing and how they're moving. Because imagine, do you really think that one of these big investors is going to go and buy a tract of land and start building homes if we're at the peak? Most likely they're
That's
not.
what it wouldn't make a lot of sense. They'd be making a really bad decision. Yeah. So that's a good point. You follow the lead of someone else that already is way further along as a builder, for example, a big builder. That's
Yeah.
a good point.
Yeah.
Louis,
no matter,
I'm sorry, only because at the time we have
Yeah.
about 8 minutes here. So let the group know kind of what you do. Obviously, you're an investor, you've been an agent for a while, you're a broker, you have team, you have investments, you have all different things you're doing.
Yeah,
But
absolutely.
as far as helping others like you're doing here, which is we're so appreciative of you being here, man. I really am. And I thank you for coming in kind of short notice, dude. I'm thinking of who I know that can have this conversation with me, and you're like the first guy I thought about it, literally.
Thank
So
you, bro.
because of your experience and just wisdom and the transactional volume you've done and stuff and the things you see and just the whole everything about you, man. Like you're just a very well put together guy, and the group can hopefully see this, and I see it. It's very clear to me. So
Thank you.
with that being said, I mean, having somebody like you, lead someone to understand these things on a regular basis through training and education and coaching, tell us what that looks like, or show us what that looks like if you want. And then we can kind of close out the meeting and talk about how folks can take next steps, either
Yeah,
with you or
absolutely.
with
So,
us together.
yeah, I'll share my screen with you. If you guys want to get in contact with me, or you want to learn more about what we do, you can visit our website at culture.estate. On the first page, the homepage, you'll see that we have some ways that you can work with us and further. Well, if you choose to do some further investing in your education, we have a program that I feel is probably like a master course in what people would love to learn, which is auction. How to buy homes from banks, how to buy homes from pre-foreclosures, how to buy homes at the sheriff's steps. A lot of people go to trustee auctions or they go to sheriff sales. That's a good way to get into the business and get some really good deals. When that inventory starts to pump down the line again, like it used to, you want to be ready. You want to have this skill set, so that way you can take advantage of all the properties that are coming in that haven't come in for the last few years. So what you can do is you can visit our website and you'll see that we have the opportunity to work with us either in the capacity of coaching. We have coaching options. We also have programs that you can work with us. The one that I recommend right now, you guys take a look at, would be the one that's ready to go, called Auction Master. We are also working on an alchemy course, which is basically taking you from beginner to experience if you don't know anything about real estate yet. So we're still taking pre-signups on that one if you're interested. But the one that's ready to go right now is Auction Master, where you'll learn how to buy properties directly from banks, or learn how to buy properties before they go to the banks at the foreclosure sales. And you can package them up and you can actually get a discount. So you guys can also email me if you want to bundle them up. Doug does have a coupon. He can share with you guys. You get a massive discount on the price if you use his discount. I believe Doug, Joe has it. I can't remember off the top of my head, but I'm sure he'll share it with everyone.
Yeah, if you don't mind, if you could add it, just make it TGC. If it's not already that, you can do that later. But TGC would be for the Growth Collective. So we have folks here that are clients of ours already in the Growth Collective, and we have folks that are looking at joining the Growth Collective. So TGC, code TGC would get you that discount, and it's a pretty sizable discount. I don't remember.
Let's
Louis,
use TGC 2023. That'll be your
there you go.
discount. So I'll put it in the
TGC,
chat.
excellent. And if one of my team members could put that on a comment inside of Facebook, TGC 2023. Louis, I want to say it was like 20% off or something like that. Is that about right or no?
I believe so. Yeah. If
Yeah, I
I'm
think it
not
was
mistaken,
20%.
it was at least 20% off. So if you guys use this coupon, it's good. It's going to be good through the end of the year. That's why it's TGC 2023. But take advantage of it so you can be ready for anything that comes our way.
Excellent.
No
And
worries.
then how can folks get in touch? You said Facebook. Is that good if they want to reach out to you, or how can they connect with
Yeah,
you
you can find
separately?
me you can find me on any social media platform under Culture Estate, or you can just go on the website and hit contact us, and I'll get the messages there too.
That's funny. Sherry just asked the question. Yeah, there you go, Sherry. He just mentioned to you. So social media would be the best way. And then
Our website's right
culture,
there.
culture.estate. So for folks that's a really cool name, and I love the name of your company, but having the culture, right? That's really cool. And I love your logo too. It's like a lion, I think, right? So that's really good.
Absolutely. He's behind me up
Um,
here somewhere.
Yeah, there you go. I see that. That's right. So is it just culture.estate? Is it
That's it.
www, or if they just type in culture.estate, it would go right to where it needs to go?
There you go. That's all you
And
need.
how do they get to that link that you showed just a second ago? Is it like a click they have to click on, or what? How do they get to the actual courses if they want to just move forward and pick up one of those courses, or the one that you mentioned?
Yeah, all you do is once you're on culture.estate, you click anywhere on this homepage and it'll take you
Okay.
to our course page.
Oh, I got you. Okay.
Yeah.
So hopefully everybody gets that. Not monitoring right now Facebook, but we're going to get the comment there for, it's again TGC 2023. I think someone else already put that there, so that's excellent.
Yeah.
And that's going to get you 20% off. And then we're going to obviously bring Lewis back hopefully in the near future, but he's just a wealth of knowledge. Get connected. I know he's a super busy guy, but he's more than happy to help you guys. You could tell his culture is to lead and serve. And that's what attracted me, like I said, to want to work with him. So appreciate all the stuff you're doing for the community,
No
man.
problem.
God bless you.
Thank
And
you.
we'll talk real soon, man.
Same here.
And in the
Take care,
meantime, if you
guys.
guys have any questions, thanks, buddy. If you guys have any other questions, you know how to reach out, go on Facebook, hit me up with a DM. If you want to check out folks like Lewis and have him come in and coach you on a consistent basis, he's come in at least a couple of times and he's got his courses there. We bring in folks like Lewis, people, friends of mine, people in the industry, leaders. We brought in a gentleman named Brad Blazer, who's raised over $2 billion. We've had my buddy Kevin Clark come in. He came in yesterday, actually. He's done real estate lending for like the past 30 years. Got an awesome network of people. Join the growthcollective.com to get coached by some of these guys, not just me, right? It's a whole bunch of people that really know way more than I know and experienced beyond my experience, but I'm there with you every time as well. I'm there almost every single meeting. I'm there as an attendee or as a presenter. So again, join the growthcollective.com and then also culture.estate. That's going to get you the access to the information that we're talking about today. So until then, I'll see you guys next week. God bless. Make it a great week and we'll talk real soon.
Thank
Bye-bye.